New CEO, a tighter belt, and a new supply chain strategy. That is behind Bernstein's call today on Peloton, initiating outperform on the stock, $40 price target, about 50% upside from here. Let's bring in the analyst behind the call, Anisha Sherman, Bernstein analyst, who writes, "It's time to buckle in for the ride." Anisha, thanks for joining us. Is this just a call in your faith in the new management?
Hi, thanks for having me. It's less about the new management, and it's more about the fact that this is still a healthy core business. It has extremely high user engagement, industry low levels of churn, and a huge TAM. And so, yes, it's decelerated from the COVID levels when people were working out 26 times per month. We're not working out that much anymore at home. But on a long run, this is still a very attractive stock with a healthy business. And the market is pricing in and all the downside. If you look at what's priced in at the market right now, it's essentially minus 75% growth on hardware and like zero growth on subscriptions, which I think is too bearish. I mean, you have to believe that it's going to grow subscriptions a little bit beyond where it was last year. Market's assuming it doesn't gain a single new subscriber and that hardware sales drop by 75%. So we think that the path from here is up and to the right.
Mike Santoli, a healthy business. That it certainly is not how Wall Street is pricing it, at least if you look at the stock decline from the highs.
Yeah, obviously, fast money in, fast money out. I mean, we still have to have a certain leap of faith in terms of confidence when it will turn, bottom line profitable, because Peloton's not being run that way now. But, $1 billion plus in trailing digital subscription revenue, just subscription revenue, when you have the market cap now down below $8 billion. I mean, it wasn't that long ago that the street was willing to put huge multiples on anything that seemed like subscription. Here we have the noise of the hardware and what can we expect about future adoption. So obviously not as easy a call as when you have present earnings, but it's, again, de-risked to a degree. And this is another situation where people in 2019, right after the IPO for Peloton, paid more than it's trading for right now.
Well, Anisha, it's especially problematic when you have weak fundamentals and lack of profitability at a time where the market is worried about Fed rate hikes and the Fed is going to get aggressive when it comes to fighting inflation. If that's the message we hear tomorrow, what happens to a stock like Peloton? Isn't that a challenge to your optimistic view?
So Peloton isn't going after the consumer that's going to be most squeezed by inflation, which is a more lower income consumer whose wallets are going to be tightened by the increases in kind of discretionary or in staples.
No, I guess
spend.
I meant just on the valuation, the whole valuation reset, higher rates, stocks, certainly unprofitable stocks that had been inflated over the past few years have just come back down to earth and have been among the most hated. It's really been the story of the NASDAQ, but Peloton certainly in the crosshairs.
Yeah, no, absolutely. I mean, Peloton was trading at kind of 6+ times sales. It's now, we think a fair valuation is about 3 times sales. So the valuation has absolutely come down. But even if you put a normal kind of, conservative valuation on it, and you look at what the market's pricing in, it's pricing in an incredible decline in trajectory, which just doesn't seem reasonable.
Anisha, thank you for joining us with the call.